Josh Brown is a halftime report contributor. He's the CEO of Ritholtz Wealth Management. Josh, it's good to have you here this evening. I'm glad we're doing this, and I'm wondering, through your own eyes, what are you hearing from your clients? What are the challenges that you're facing as an advisor?
That's such a great question to lead off with, Scott. And for context, we work with about 900 households across the country, about 17 client-facing advisors at my firm. And I asked them that question. And one of the recurring themes was people seem to be more concerned about their own health and the health of their families than they are about their money at this stage, which separates this recession and this bear market from all others that preceded it. Now, that won't last. And ultimately, people are going to look at how they're investing, how they're saving, and what they're doing. And the financial aspect is going to come more to the fore. And I think that's what we're going to try to do tonight is try to tackle some of those issues. So the good news is I brought two of, in my opinion, the most knowledgeable, accomplished financial advisors in America to help me with some of these questions that were asked. I want to bring on Carolyn McClanahan from Life Partners. Carolyn is, in addition to being a financial advisor, also a medical doctor practicing, one of the few in the country, and Lazetta Braxton. Lazetta is joining us from Brooklyn tonight. She works with the mass affluent and high net worth investors all over the country. The first question that we got, guys, I want to get into right now, which is there an allocation that works across the board for more than one age group, more than one income? Is there any kind of general portfolio advice that we can discuss to get into this? Carolyn, what do you think about that question?
Well, to me, the two most important factors that should drive an allocation is, one, how long do you have before you have to use your money? And then number two, how much can you afford to lose? And so if you can't take a lot of risk because you need your money soon, you need a conservative allocation. And if you can let your money sit there forever and you don't mind watching it go up and down, you can be much more aggressive. But people who are early in retirement or just getting ready to start retirement, they, for the most part, need to be fairly conservative.
Right. So it's not necessarily just about age. It's about when you're using the money and for what. That should really drive the answer to that question. Lazetta, what's your take when you get questions from people? I imagine you talk with people of all different generations. How do you answer that question when they say, well, how much stock market is too much? How much bonds? How much cash? What kinds of guidelines do you give people to help them figure that out?
It's very similar to what Carolyn has said about when you need the money, i.e. when you're going to start taking it out. And I also like to say this risk tolerance. You know, how do you respond to when the market does what it's going to do? Ups and downs. And right now we're in a down market. So do you throw your hands up in the air and say, wow, what a ride? Or do you curl up in a fetal position and say, my goodness, I'm never going to retire or not going to be able to get through retirement? Or do you say, oh, another day at the office? So that range of how you respond when you hear the news gives you an indication of how much you can really handle what we say risk, i.e. how much you can handle in stocks. So I like to marry that with their timeline, what their goals are, and really can they stomach this ups and downs? And sometimes, you know, there's software that helps that. And sometimes it's just the question, you know, will you be able to sleep tonight in the next couple of weeks, in the next few months, in the next couple of years, waiting for the stock market to rebound? So I want to hear intimately what they feel about it as well.
Yeah, so that's such an important aspect of it. You know, people talk in terms of what's the optimal portfolio, but an optimal portfolio lives on software. We have to live with these portfolios in real life. And sometimes what's an optimal allocation is not livable for the person that's actually going through that experience. Carolyn, what do you say to this idea that risk tolerance is a moving target? Meaning, in the middle of a month like March, with the S&P 500 in the midst of a historic decline, people all of a sudden might answer risk tolerance questions with, well, I'm a very conservative investor, it turns out. But then fast forward, the market has a 3-year return of 10% a year. All of a sudden, people's risk tolerance get amped up. How do you address that?
Oh, it definitely changes. And so one way that we like to address it is we put portfolio losses in the realm of what's the real money that they would lose. Let's say somebody has $1 million portfolio. If you say, are you okay losing 12%? And they go, oh, that's fine. I can do that. But when you say, well, that's $120,000, they're like, that's a lot of money. And so we hammer in, especially when times are good, we hammer in how much they have the potential to lose and can they stomach that. And one other way that we help them prepare, people who are actually living on their money, we make certain that they have at least 5 years of cash flow in fixed income so that when the market goes haywire, we can say to them, and it makes them feel so much better too, that you don't have to worry about this. You have at least 5 years of cash flow going forward, and then that prepares them for times like these.
Lazetta, I want to get into one of the more technical questions. I'm gonna read directly from a viewer. Started our Roth conversion strategy this year, retired and 58 years old, converting up to 24% until required minimum distributions. That sounds like it's a strategy to enable the children to inherit that IRA on a tax-free basis, front load the taxes now. Is that the type of thing that people should do when the market's fallen, the tax impact is less? Should they look at a strategy like that to lessen the burden on whomever might inherit those assets later?
You mentioned it. It's a strategy. There are a lot of factors that go into that strategy. You know, where you think tax rates are versus where you think they're going to be in the future. What does your income look like? So is your tax bracket less because you've decided to retire, or unfortunately you got the cut? So you have to really kind of think about personally for this particular situation, age, when you're making these withdrawals for the conversion. And also when you're thinking about the children going forward, more than likely, depending on their age, they could be even in a lower tax bracket. So while I would like to say this is absolutely the way certain people should go, I want them to be thinking about where tax rates are now, where they believe they are in the future. If they think they're low, what is your income bracket looks like vis-a-vis what your children's bracket could look like, and who would be better off taking those, those tax hits in terms of taxable income. We know that the Roth, once it's distributed, no big deal. The taxes have already been paid, and I guess that's one of the angles they're looking at.
Those are absolutely the important considerations. Carolyn, here's somebody with a 401k question. I can't pick and choose stocks. Any advice on funds would be great. How do you broach that topic? Someone trying to figure out what they're doing inside of a 401k.
Well, it's really important first to make sure that you have a great 401k that has low-cost funds, a lot of passive funds, index funds that have very, very low fees. If your funds don't have low fees, talk to your employer, make sure that they start getting funds that do have low fees. And it's important to make sure you're diversified. So if you don't have a lot of money, it makes it hard to diversify. Your fund probably has what's called a life cycle fund that may be a wise choice to use. And as you get more money, that's when it's really important for you to determine what's the right allocation for you, and then use low-cost funds within the 401k to meet that allocation.